TSX slips on Middle East tensions. Canada stock market. The S&P/TSX Composite Index fell over 1% to trade below 35,000 on Wednesday, as renewed U.S.-Iran tensions fueled risk aversion. President Trump said the memorandum of understanding with Iran to end the conflict was over, reviving concerns over potential disruptions to global energy supplies. Higher oil prices renewed fears of energy-driven inflation and higher interest rates, weighing on financials. RBC minus 1.5%, TD Bank minus 3%, and BMO minus 2% were down. Mining stocks also came under pressure as gold prices slipped and Trilogy Metals minus 1%, reported a wider second quarter loss. Agnico Eagle, Barrick, and WPM fell about 4%. Tech stocks weakened, with Shopify down 4%. Meanwhile, minutes from the Fed's June meeting showed officials remained divided over the need for further tightening. While several policymakers argued the current policy stance was not restrictive, most also said additional rate hikes could be warranted if inflation remains elevated. U.S. 10-year yield extends rebound. United States government bond 10. Why the yield on the 10-year U.S. Treasury note rose up to the 4.6% mark on Wednesday, the highest since May, as higher energy prices magnified the impact of a hawkish Federal Reserve. Fuel prices soared after a new wave of attacks between the U.S. and Iran reignited concerns that energy from the Middle East will be blockaded. The pro-inflationary risks were consistent with minutes from the FOMC's June meeting, which indicated that a few policymakers saw higher core inflation readings and a robust labor market, making the case for a rate hike. Rate futures continued to show a loose consensus that the Fed is due to deliver one rate hike this year, although nearly half of the market was positioned for more than one hike. Bonds were also under pressure from Fed Chairman Warsh's earlier calls for a smaller balance sheet, to be achieved by trimming the central bank's holdings of longer-term notes and bonds. Dollar lacks direction. United States currency. The dollar index was little changed around 101 on Wednesday, as investors assessed the latest escalation in Middle East tensions. President Trump said that as far as I'm concerned, the ceasefire is over, while threatening additional strikes on Iran and a blockade of the country's ports. The U.S. also launched fresh strikes on Iran and revoked a waiver that had allowed the country to sell crude oil on global markets. These developments followed a series of attacks on tankers transiting the Strait of Hormuz in recent days. Oil prices surged again, reviving concerns about inflation and the prospect of monetary tightening. Reflecting this shift, traders increased their expectations for Fed rate hikes, with the implied probability of a September rate increase rising to around 69%, up from 58% the previous day. Meanwhile, minutes from the latest FOMC meeting showed that policymakers were divided over the future path of interest rates and discussed a range of economic scenarios. Fed divided over interest rate outlook. United States interest rate Fed officials were divided on the future of interest rates and discussed a range of scenarios for the evolution of the economy and monetary policy. Minutes from the FOMC meeting in June 2026 showed participants generally assessed that upside risks to inflation remained elevated, and a few commented that, in light of these developments, there was a case for raising interest rates. Most participants also pointed to scenarios in which, in the context of stable labor market conditions, inflation would remain elevated due to strong AI-related demand, the conflict in the Middle East, or the effects of tariffs. In such scenarios, almost all of these participants indicated that some policy firming would likely be warranted to return inflation to 2%. However, under their most likely economic outlook, many officials expected interest rates to end the year at or slightly below their current level. The Fed kept the federal funds rate unchanged at 3.50% to 3.75% in June, in line with expectations. U.S. stocks hold losses after FOMC. United States stock market. U.S. stocks held losses on Wednesday as higher energy prices added to a less favorable macroeconomic backdrop. The S&P 500 and NASDAQ 100 were around 0.4% lower, while the Dow fell a sharper 1%. Treasury yields rose after President Trump said the ceasefire with Iran was over following strikes by both sides, driving oil prices to surge and markets to reconsider inflationary risks. The risk of higher inflation was aligned with FOMC minutes, showing some members made the case for a rate hike in June. Credit-sensitive sectors fell, with JP Morgan and Visa down 2%, while Home Depot and GE Vernovia sank 3%. Meanwhile, AI hyperscalers were mostly lower after worries of overspending in data center infrastructure weighed on the sector earlier this week, with Alphabet, Amazon, and Microsoft dropping more than 1%. On the other hand, Broadcom gained 5% after expanding its agreement with Apple on US-made components. Also, Nvidia gained 1% as Chinese firms planned to buy more H200 chips. European stocks dropped sharply. Euro area stock market European stocks closed sharply lower on Wednesday, tracking a global equity downturn after Iran and the U.S. exchanged new strikes and raised inflationary risks for the Eurozone. The Euro Stoxx 50 fell 2% to 6,190, and the Stoxx Europe 600 fell 1.8% to 634. The U.S. moved to block Iran oil sales after the war was reignited and President Trump invalidated the current ceasefire. The resulting surge in fuel prices raised sovereign yields to reflect expectations that the ECB is likely to deliver more rate hikes this year. Santander and Deutsche Bank sank more than 5%. Also, UniCredit dropped 2.9% after it increased its stake Commerzbank, increasing the likelihood of a full takeover in the upcoming quarters. Meanwhile, the AI trade continued to be unwound as software companies came under new pressure, with SAP sliding 4%. DAX closes deeply in the red. Germany stock market. The DAX 40 settled about 2.2% lower at 24,897.5 on Wednesday, the biggest daily decline since March 19th, as rising Middle East tensions fueled risk aversion. President Trump said at the NATO summit that the ceasefire with Iran had collapsed following mutual attacks, adding that the U.S. would probably strike the country hard again tonight. Oil prices subsequently jumped on fears of renewed military action and disruptions to energy supplies, heightening inflation concerns. At the same time, traders continued trimming exposure to semiconductor and AI stocks amid valuation concerns. Losses were broad-based, led by banks, financials, autos, consumer discretionary, and industrials. Real estate Vonovia led losses, slipping 5.7%, followed by Deutsche Bank, minus 5%, Heidelberg Materials, minus 4.6%, and Rheinmetall, minus 4.5%. Mercedes-Benz Group slid 3.9%, weighing on auto stocks after reporting an 8% drop in Q2 car sales. Lufthansa fell 6.5% on higher oil prices and a Citigroup downgrade to sell. FTSE 100 tumbles by over 1.5%. United Kingdom stock market. The FTSE 100 fell more than 1.5% on Wednesday after U.S. President Donald Trump told the NATO summit in Turkey that the ceasefire with Iran was over, amid renewed hostilities in the Middle East that sent oil prices surging. Mining stocks were among the biggest laggards, with precious metals producers Endeavour down 7.3% and Fresnillo down 5.8%. Elsewhere in the mining sector, Antofagasta lost 6.4%, Anglo American retreated 5.6%, and Rio Tinto fell 5%. In the broader market, FTSE 250 homebuilder Vistry plummeted 7% following an operational update, an ongoing review of its chief executive, and the announced departure of its chief financial officer, despite projecting full-year adjusted pre-tax profits to meet current market expectations. On the other hand, oil majors BP and Shell advanced 2.3% and 3.1%, respectively, benefiting from the surge in crude prices. Germany 10Y bond yield hits 6-week high. Germany government bond 10Y. Germany 10-year government bond yield increased to 3.09%, the highest since May 2026. Over the past 4 weeks, Germany 10Y bond yield gained 2.81 basis points, and in the last 12 months, it increased 45.28 basis points. Heating oil surges over 13%. Commodity heating oil futures in the U.S. surged over 13% to $3.75 per gallon on Wednesday, the highest in over 1 month, amid mounting threats to supply. Iran and the U.S. exchanged a wave of attacks after the IRGC struck a tanker crossing the Strait of Hormuz, prompting President Trump to negate the validity of the current ceasefire after multiple tankers turned back from crossing the choke point. The increase in crude oil prices was exacerbated by soaring crack spreads in distillate fuel as tight refining capacity drove energy companies to hike sales prices. On top of that, major diesel producer Russia announced it would halt exports and shift to an importer, as higher crude prices exacerbated the series of Ukrainian strikes on the country's largest refineries. Heating oil prices had dropped sharply since peaking at a record high of $4.70 after in late March, but recently rebounded to trade over 40% above levels from before the conflict. Colombia exports jump rise in May. Colombia exports Why Colombia's exports rose 19.2% year-on-year to $5.19 billion in May 2026, after increasing 11.7% in April. The gain was driven mainly by a 33.3% rise in fuel and mining exports, reflecting a 32.4% increase in shipments of petroleum and petroleum products. Agricultural, food, and beverage exports edged up 0.7%, supported by higher exports of cut flowers and foliage, 24.9%, and coffee extracts, essences, and concentrates, 89.2%. Manufactured exports rose 0.2%, led by chemicals and related products 8%, and machinery and transport equipment 12.6%. Exports from other sectors surged 67%, largely due to a sharp increase in non-monetary gold shipments. Meanwhile, crude oil exports totaled 11.4 million barrels, down 18.1% from a year earlier. Gold falls to one-week low on Trump's Iran remarks. Commodity gold extended its decline to around $4,030 an ounce on Wednesday, touching its lowest level since July 2nd, after U.S. President Donald Trump declared the interim peace agreement with Iran over. His remarks sent oil prices surging more than 5%, fueling concerns that higher energy costs could stoke inflation and keep U.S. interest rates elevated. Speaking at NATO's summit in Ankara, Trump said he had no interest in further engagement with Iran and warned that Washington would likely carry out additional strikes later on Wednesday. His comments marked another sharp shift in a conflict where rhetoric from both the U.S. and Iran has repeatedly oscillated between military escalation and diplomatic overtures. Markets are now pricing in at least one Federal Reserve interest rate hike by the end of 2026. Meanwhile, China's central bank reported its largest monthly increase in gold reserves in more than 2.5 years in June, underscoring continued official sector demand for the precious metal. U.S. crude oil inventories rise after 10 weeks of declines. United States crude oil stocks change. U.S. crude oil inventories increased by 2.998 million barrels to 411.3 million barrels in the week ended July 3rd. Marking the first rise after 10 consecutive weeks of declines and compared with market expectations for a 2.4 million barrel draw. Crude stocks at the Cushing, Oklahoma, delivery hub decreased by 52,000 barrels. Refinery crude runs fell by 172,000 barrels per day. Gasoline inventories declined by 1.904 million barrels to 212.1 million barrels, exceeding expectations for a 1.6 million barrel draw. Distillate stockpiles, which include diesel and heating oil, fell by 4.98 million barrels to 103.6 million barrels, compared with forecasts for a 0.6 million barrel increase. Net U.S. crude imports rose by 1.096 million barrels per day. IMF keeps 2026 growth forecast largely unchanged. The IMF kept its 2026 global growth forecast virtually unchanged at 3%, just 0.1 percentage point below its April projection, citing the world economy's stronger-than-expected resilience to the Iran war and robust AI-related investment, according to its July 2026 World Economic Outlook. The 2027 growth outlook was revised upward to 3.4% from 3.2%. Despite the slight upgrades, the IMF warned that risks remain tilted to the downside, and the full economic impact of elevated tensions, including renewed U.S.-Iran strikes, may still take time to materialize. Global headline inflation is now expected to reach 4.7% in 2026, up from 4.1% in 2025, before easing to 3.9% in 2027. The IMF projects growth of 2.3% for the U.S. in 2026 and 2.2% in 2027, while China is expected to expand by 4.6% and 4.1%, respectively. India's growth is forecast at 6.4% in 2026 and 6.7% in 2027, Japan at 0.6% and 0.7%, the Eurozone at 0.9% and 1.2%, and the UK at 1% and 1.3%. U.S. wholesale inventories growth slows. U.S. wholesale inventories rose 0.1% month-over-month to $941.8 billion in May 2026, following a 0.7% increase in April and below a 0.3% gain in the advance estimate. The latest reading marked the third consecutive month of slower inventory growth after a 1.5% increase in March, the strongest since mid-2022. Compared with a year earlier, wholesale inventories were 4% higher, accelerating from an upwardly revised 1.2% increase in May 2025. Meanwhile, the inventories-to-sales ratio for merchant wholesalers, excluding manufacturers' sales branches and offices, stood at